A very good morning to our MIIM members and friends in Germany, and a good afternoon to our participants joining from India. Thank you for joining us today for the webinar, India's Foreign Exchange Regulation Framework, Managing Inbound and Outbound Investments for German Businesses, organized under the Make in India Mittelstand program in association with our MIIM partners, RÖDL and Partner, and for today, guest ICICI Bank. I am Monaz Desai-Tantzscher, your MIM coordinator in Germany, and I will have the pleasure of taking you through today's session. Before we continue some technical aspects of our program, the following functions are available to you. In the upper right corner of your screen, you will find the control panel. Here you can adjust the audio settings and choose, for example, between your headset or the computer audio. A bit further down the dashboard, you will find the panel. Here we request you to post your questions, and we shall take these up in the last leg of the webinar during the Q&A. For those who are new here and joining us for the first time, allow me to briefly introduce you to the Make in India Mittelstand program. MIIM, as it is fondly called, is the initiative of the Department for Promotion of Industry and Internal Trade and the Embassy of India in Berlin. It provides a platform that integrates a wide range of support services for the German Mittelstand companies and family-owned enterprises. The program offers all support like strategy, consulting, mergers and acquisitions, operational market entry support, tax and legal support, financial services, project financing, location services, technology collaboration, and facilitation of approvals from central and state government agencies under a single umbrella. In today's webinar, our expert speakers will provide in-depth knowledge on India's foreign exchange regulatory framework, focusing on how the changes can streamline operations and enhance your profitability. We shall commence today's webinar in the introduction of our first speaker and my esteemed colleague, Neha Sharma, joining us from Delhi. I'm delighted to welcome you. Neha is an associate partner, head of corporate and compliance service line, who has been associated with RÖDL and Partner with more than 17 years now. She carries a formidable array of expertise in critical areas, including market entry, mergers and acquisitions, foreign exchange regulations, and corporate compliances. A company secretary by profession, she holds degrees in both law and commerce and has earned a certificate on M&A from the prestigious Institute of India, IIM Ahmedabad. We extend a warm welcome to Ms. Neha Sharma and are honored to have you join us here today. Neha, I now pass the virtual mic to you. Thank you.
Thank you so much, Manaz, for such a warm introduction of mine. It's my pleasure actually to take you all through my presentation. But first of all, a very good morning to everyone who are joining us from Germany, and very good afternoon for all of us joining us from India. So let's start with the presentation. Yeah, so during our presentation, we will briefly touch upon the conventional tools that are available to the German investors to invest and fund their Indian subsidiaries. And we will also touch upon major regulatory aspects associated with them. Some do's and don'ts which have learned from our long experience in this field, we would like to share those as well with you, because along with the theory and law, all these practical experience are equally important. And we will also briefly touch upon the repatriation of profits of the Indian company and the regulatory aspects around it. Thought process of investing in any market starts with searching for the answers to the right questions. So for example, why India? Where in India? It's a very big geography. With whom to collaborate? Which firm is the most suitable to enter the Indian market? How to set up an entity or a manufacturing facility, how to fund the Indian entity, and eventually how to take your return of investment back to your country. We would be happy to answer all your queries pertaining to these questions. However, in today's presentation, we are making a long jump and we will focus on the last two questions, which are how to fund a company, Indian entity specifically, and how to get the return on investment back. We will keep the entire presentation very broad to keep it simple and easy to understand. the basic ideas. However, I would like to highlight, and I must say that you would also appreciate that each case is very unique, and it is always advisable to have a detailed analysis of your particular case with your consultants and create your bespoke resolution for your funding requirements. So we start with our presentation. There are several conventional methods that are available to a foreign entity to invest in India and to fund its entity in India. So here investment and funding are different concepts. In order to say that you are a foreign invested company, it means that a foreign company has taken the equity shares of the Indian company. So direct investment in India can be done only by way of subscribing to equity capital or any other securities which are considered as equity under the law. For example, compulsorily convertible preference shares. There are other ways of funding as well, other than share capital. Share capital is very simple way of funding the company, and you can any time increase your share capital whenever you wish like to increase the funds in the company. However, there are other modes are also available. For example, intercompany loans, that is the loan from the parent company or a group company to an Indian entity, which can be used for a certain areas that is restricted. So these loans from the parent company are famously called in India as external commercial borrowings, or ECB in short we call. So you will hear this word ECB very often during this presentation from me. And ECB can be made available in a form of a cash loan, also preference shares or debentures, because the preference shares and debenture both are of having the characteristics of loans. So under the law, they are also considered as ECB. There are other conventional way as well to fund a company, old schools like loan from the local Indian bank, that is also can be explored. And these options, for example, the share capital, ECB, and loan from the Indian bank cater to your long-term funding requirements, and to cater to your short-term funding requirements, the route of trade credits and advance against exports can also be explored. In my presentation today, I will focus on the conventional methods, that is the share capital, and the intercompany loans, that is ECB. I would also like to highlight that whenever there is a cross-border transaction, the foreign exchange regulations come into the picture. So today we will focus more from the foreign exchange regulations, the provisions around it. The regulatory authority of foreign exchange regulation is Reserve Bank of India, which is you can imagine it as a Central Bank of India. In short, we call it RBI, again, a term that I'm going to use a lot during the presentation. Now, how RBI operates? So RBI has delegated a wide spectrum of its authorities to the local banks, which we call authorized dealer bank. And in a simplest manner, you can understand that they are not any special kind of banks. They are banks with which your Indian entity is working on a day-to-day basis, the banks which are facilitating this foreign cross-border transactions. So, and their duty, the RBI has given this duty to the bankers to ensure that the transactions are genuine, that both the parties, the lender, the borrower, the sender of the money, the receiver of the money are complying to the law. They are also given a lot of discretionary powers to allow certain non-standard transactions. So authorized dealer bank play a very big and crucial important role whenever we talk about the cross-border transaction. And this is the reason that we have our ICICI onboarding today's session. And I would end this slide at least with a note that it's very important to choose a right bank for your Indian entity, because choosing a right bank makes a lot of difference with your experience with the cross-border transaction. And I'm sure that my co-speaker from ICICI Bank would also throw some light around these aspects in his presentation. So yeah, moving ahead. This slide, if you can look at it, I have added just to give you an idea of the statistics of the share capital and the ECB that we had in India in year 2024. So during the year 2024, India witnessed the total FDI inflow of euro 70.40 billion, which was 14% increase from the previous year. In ECB, the total ECB registration has been euro 41.08 billion, which was 21% increase over the same period. And since ECB are can be used for a certain end purposes only, therefore the top purposes for which the ECB was called in was the import of capital goods, refinancing rupee loans, working capital, and general business needs of the company. So these are the top purposes for which the ECB has been received in India majorly. But of course, there are other end uses as well for which the ECB can be called. Now let's dive into some details, and I will start with investment and funding by way of capital. When we talk about the word investment, it can only happen by way of subscribing to equity shares of an Indian entity. So if you subscribe any other share of an Indian entity which is not equity share, then the Indian company will not be considered as foreign investing. So the contribution in equity share is important. So that is the way of making foreign direct investment. In short, we called FDIs. There is one more kind of capital which is recognized by the law, which is preference shares. But due to its characteristics under the foreign exchange laws in India, it is treated as ECB because it has few elements of loan in it. And it is why we are talking about this differentiation between the equity shares and the preference shares, FDI and ECB, because this differentiation decides upon a lot of formalities that goes into it, and then formalities for bringing the money as an FDI and bringing money as ECB is quite different. It's incredibly different. So you have to be very careful that in which method you would like to get your money in. From compliance perspective, infusing capital, equity capital in India is relatively much easier than ECB. Right now, I'm assuming, and when I say easy, it means that you don't have to get any specific approval from the authorities. But of course, if you are dealing in some prohibited areas or restricted areas or sensitive areas, then the government approval may require. But in most of the cases, I would assume we are coming from the usual day-to-day trading, manufacturing companies. Most of the work comes under the automatic rule, which means that you don't have to ask for a special permission from the Reserve Bank of India before making investment in India. And there are certain formalities. For example, valuation of shares, you have to file certain forms with the registrar of companies, you have to call your board meetings, shareholder meetings, you have to make filings with the Reserve Bank of India. So these are the formalities that will stay in the picture, but most of them come after you bring in the money. So you don't have to wait for doing something before you can put in the money. So if you are in hurry, you need the money very urgently, then equity share capital is a very conducive way of infusing funds into the company. Now, since we are talking about the share capital here, I will digress a bit from the foreign exchange regulation, and I will touch upon a new requirement, not new, but fairly new requirement that has been introduced from the Companies Act perspective with respect to share capital. And I see that there is a lot of question around in the market about this new development. Therefore, I'm just touching a bit here. So the new regulation requires now that every Indian company will have their share certificates in an electronic form, which in short we call in a dematerialized format. So we quickly take a look at the requirements of having your share capital into a dematerialized form. So now it's necessary for all the private limited companies, barring small companies. There is a definition that which company is considered as a small company. So it's not just, it's not subjective. You really have to see the criteria to check whether your company is small or not. So every private limited company except small companies have to have their shares in electronic form. This necessitates the shareholder of such Indian company to open a digital account in India to keep these electronic share certificates in it. And also, this also impact on the further allotment of shares or future transfer of shares that you may do in future. So now on the entire allotment of share and transfer of shares formalities have converted into a digital method for which the shareholders of the company have to have demat account, we call it in short. Here, there's a lot of confusion about the small company, and I would like to emphasize again on this stage that if you are having an Indian subsidiary in India, of course, then irrespective of the quantum of its share capital or turnover, it is not considered as a small company. So your subsidiary company here in India is required to have its shares in a dematerialized form, and you as a shareholders must have a demat account here in India to hold those electronic shares. So please keep that in mind. And again, in case you do not have demat account, then it won't be no longer it would be feasible for you to acquire more shares or to do transfer. The timeline to comply with this law for existing entities is already passed. It was 30th June 2025. So in case this has not happened, then it may attract penalties as well. But if you are a newly incorporated company in India, then you still have time until the end of 18 months from the end of your first financial year. But since opening a demat account, especially for the German shareholders, is a lengthy process because of a lot of legalization formalities that come into the picture, we always advise to start with at least the paper formalities well in advance so that you have your demat account in time and you abide by the law. So we would suggest that you please go ahead and cross-check whether these compliance are done or not, because they may create hindrance for you in case you are planning for the further capital infusion or transfer of shares. Now this slide shows a very quick do's and don'ts which we have collated basis our past experiences uh, uh, um, in this field. For example, it's very important that while making the transfer of the funds, the parent company must mention the correct purpose code. Please ensure that all the declaration that you have given with respect to your foreign direct investment is correct, all the details are right, and try not to send the share capital in multiple tranches or not to make any payment on behalf of third party. So these are few small little points which make a big impact and effect on your cross-border transaction, and it can make those simple transaction difficult or easy. Now we move ahead to the intercompany loans, which are external commercial borrowings, ECBs. The ECB can be granted, as I said, in several forms like cash or preference shares or debentures or long-term trade credits, etc. The ECB is now available to all such entities which are eligible to receive foreign direct investment. So earlier it was not the case. Only few type of entities were allowed to have ECB, but in few years the government has relaxed the regulation around ECB, and now which has actually made the ECB very popular way of funding. Despite share capital was always there in hand, but now ECB is picking up and has become a very popular way of funding. Despite the fact that it's more still closely monitored and regulated than share capital, and it also has strict restricted uses, but still the benefits that ECB provides, especially when the funding is of a large scale, ECB is a better way to go ahead with in most of the cases. It provides relatively a good cost efficiency and also flexibility to both the lender and the borrower, which are generally the parent and the subsidiary company. So ECB is actually a good solution for a long-term funding requirements. How we apply for ECB. So in order to apply for an ECB, there is a form that we have to fill and submit with the authorized dealer bank along with some supporting documents. Once the authorized dealer bank is satisfied with the information given to them, with the supporting that are given to them, they issue a loan registration number, which in short we call LRN. So unless we have LRN in our hand, the ECB funds cannot be remitted into India. So that's why, I was telling you that if you want your funds in hurry, then share capital infusion is a better option. But in case you have time, then ECB is a better option, because you can not just let the money come in a form of ECB unless you have done certain number of formalities, which take not many days, but yeah, few days before you are eligible to actually remit funds into India in a form of loan. So there are certain limitation with regard to the maximum interest rate that you can apply as a lender on the ECB, and also the minimum average maturity period has to be adhered, which is different for the different type of end users, so you have to be little careful around it. The repayment of the loan has to be carefully thought about. So these are certain restrictions or regulations around the terms and conditions on which the ECB can be availed, but those are in most of the cases are easily be manageable, so you don't have to worry about it and go ahead with it. So to conclude, I would say that though ECB is very closely monitored and regulated, the benefit that it provides overshadows the formalities in most of the cases, and it is continuing to be a favorite method of funding, especially in the case of a long-term and heavy-duty funding requirements. For short-term funding requirements, the trade credit method can be explored. Now, what is trade credit? So it's an option given under the law where the foreign seller of the goods, which we can assume that generally is a foreign parent company or a group company, can agree with the Indian purchaser, which is again is generally a subsidiary company, but of course it could be a different cases as well, and there may be no nexus between the foreign seller and Indian purchaser, but still the benefit of trade credit can be availed, which is that both the seller and purchaser can enter into an arrangement to make the payment of the goods in a tranches, which is spread within the span of 6 months to 3 years. So it gives Indian entities some time to clear its debt, and thus acting as an indirect way of short-term funding solution. Similarly, it is also permissible to grant advance to an Indian entity against the exports, which provided that the goods are delivered within 1 year from the date of advance. So similarly, to support longer credit period for the payment against export made from India, the timeline has been extended from the 9 months to 15 months, which allows now the longer credit period to the foreign purchaser. So these are few ways for catering to a short-term funding requirements. But of course, we wish that life and law was that easy. So we always have to be careful that with trade credits as well, there are certain terms and conditions that are attached with them, and you have to really evaluate your case according to that, because sometimes even the minute changes in the fact changes the whole scenario and the applicability or the the benefits that are there under the law. So it's important that you carefully analyze your each case and decide that which method is more suitable for you share capital, ECB, or trade credits. I'm not going into too much details on the terms and condition, which you can already see on your screen, where I have mentioned about the maximum limit up to which you can have ECB, or the negative list, as in the list of end uses for which you cannot use your ECB, and how much interest you can levy on your ECB, in what kind of currency you can have it, and other regulations. They are there on the screen, but right now I'm not going into the detail. These are few, again, do's and don'ts which we have curated basis our experience. So it's important to draft a very robust ECB agreement before you enter or decide to have ECB. You put the requirements that you cover all, at least the mandatory requirements under the law, under in your ECB agreement. We have seen in past that sometimes parent and subsidiary think that, okay, it's just us, what would go wrong, so let's just prepare 2-pager and close the deal. But it's strongly recommended, please do not do it. Please consider it as a serious case. Prepare an elaborative agreement. Think about the situations, and your subsidiary company may face some financial issues and may not be able to repay your ECB. Then what the recourse that you have? Would you like to levy some penal interest there or not? So these are few aspects which really help you in the long run. From again, practical perspective, you can just check with your bankers as well if there are any special requirements that they would like to have before approving the ECB. So a good dialogue with the bankers before you plan to bring funds in a form of share capital or ECB in any form, it always helpful, because sometimes with each bank the requirements may vary a little bit there. So it's always to have your advisable to have your bankers on the same page when you start working in this direction. Now we move on the repatriation of the return of investment from Indian subsidiary. So dividend is the most popular and conventional method to do so. The dividend can only be paid in the case of profits or accumulated profits in the company. So if the company is not earning profits, then you won't be, of course, able to use the reserves or maybe the cash that is available in your company to take back as dividend. Generally, it's a very easy transaction. The AD bankers allow the repatriation of dividends, but of course, subject to the fulfillment of necessary compliances and also compliance of the withholding tax deduction. A dividend is taxable in the hands of receiving shareholder, and the dividend distribution tax, which was there on the Indian companies, is now abolished. So it's no longer there. It's just a taxable income in the hands of shareholders. So you have to do withholding tax formalities before you send your dividend back to your shareholders. So dividend remains always the conventional method to repatriate the profits to the parent company. There are few non-conventional methods as well. For example, buyback of shares. Now, what is buyback of shares? When the Indian company buy its own shares from its own shareholders and pay them a consideration in exchange of the shares and use its profit to act as consideration, it is a buyback of shares. Similarly, the reduction of share capital, there could be several reasons because of which you want to reduce your capital, and then your profit can be utilized to reduce the capital, and these profits are moved to the shareholders' pocket eventually. But these are very special circumstances where the buyback or reduction of share capital method is used to repatriate the profits. And majorly when these kind of methods are used, using profits are not an underlying reason, but there are different, the tax reasons, etc., could be there, because of which you choose buyback or reduction of share capital. But still, you can always keep in mind that besides dividend, there are other ways as well to repatriate of funds. This is a typical way uh, 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 in which the dividend move. In case your company is your Indian company is a subsidiary, and you have, of course, two shareholders holding shares in their independent capacity, then the dividend will be distributed and sent to both the shareholders in a shareholding proportion, that in the proportion of their shareholding. However, in case of a wholly owned subsidiary, where there will be, of course, always two shareholders, but the beneficial interest of the complete 100% shares is vested in one majority shareholder, then in case the dividend is declared, the entire amount of dividend can be paid only to that majority shareholder. Then you don't have to route your dividend to the different minority shareholder as well. So this is the typical way in which the transaction of dividend payment is seen. Now moving on to the do's and don'ts. It's Most of the time it's a very simple transaction, but it's important that you remember to do your withholding tax requirements, that you get a certificate from your chartered accountant to this effect, to ensure that all the compliances are there. Also, most of the bankers do check before to allowing the remit of your dividend, that all the compliances from the past related to the share allotment, share transfers are complete, and the bank is also informed and have the supporting in hand. So unless so it's important, so your all past compliances also play a very big role when you talk about the repatriation of the funds from India to Germany, or while also bringing the fresh share capital or ECB, because bank ensure at that time that you are a compliant company and you have done all the past compliances. So please check, if you are thinking about or planning about bringing more share capital or loan into the company, that your past compliances are also done and you have proof of all the filings done and approved in your records handy before you initiate with these transactions. Yeah, so I think that's all from my side on this topic. I did had curated few FAQs for each section, but I think I will skip for the time being. And yeah, but if need arises, we can have a bilateral dialogues also. So yeah, that's all from my side. Thank you so much.
Thank you very much, Neha, for that insightful navigation through the main law, along with the digitalization of finance, and also for those those small critical notes on how to stay on the right side of the law. And you mentioning a couple of times dialogue with your bankers. We are going
Yes,
to take
yes.
you up on that.
Bankers
And
are very important.
yes, I'm going to take you up on that, and I'm going to do exactly the same. So, ladies and gentlemen, our next speaker, and as our first speaker has advised, contact the banker. So, we have Mr. Balbeer Singh,
Yes.
Product Head, Capital Account, Bank Guarantee, and other products. He has a distinguished career of over 20 years in banking and financial services and is currently team lead of cross-border capital account transactions at ICICI Bank. Throughout his journey, he has specialized in translating complex market needs into high-performing user-centric solutions. So, Mr. Singh, thank you very much. We are very happy to have you join us today, and we wish you all the best. And we're very eager to hear what you have to say. So, Mr. Singh, the stage is all yours.
Yeah, thank you very much, Monaz, for the introduction. Guten Morgen to my participants in Germany, and Namaste and good evening to the participants in India. Okay, so today we'll be talking about the regulations, the framework for cross-border investments in India. Okay, so most of you would be aware that I hope I'm audible. If anybody can just confirm if I'm audible. Yeah.
Yes,
Okay.
yes,
Uh,
you are.
Thank you. Thanks. My colleague Parth from Germany is actually presenting this, and I have my colleague Keshav also would be taking up a subsequent session on overseas direct investment. I'll be talking about the FDI. Yeah. So most of you would be aware, India, one of the fastest growing large economies, attracting a lot of capital as well as talent from the globe. It is good for everyone to understand the regulations before we make any investment. Okay, so we begin with a foreign direct investment on how it works. Yeah, Parth, if you can move to the next slide, please. Yeah, the next one, please. Okay, so foreign direct investment in a form of equity investment by a person resident outside India on a repatriable basis can happen in a listed entity in two forms. So it's basically a listed entity and an unlisted entity. In a listed entity, if the investment is below 10% of the paid up capital, it becomes a foreign portfolio investment. If it is greater than 10%, as it is highlighted on the north slide, is a foreign direct investment. And any amount of investment going into an unlisted entity is a foreign direct investment. So this is a basic understanding of FDI, how it can be done in a listed and an unlisted entities. We move on to the next slide. Okay, so this talks about the overview on FDI. What is the definition, regulations, what are the routes available? So starting with the definition, investment made by a person resident outside India on a repatriable basis, the capital instrument of the company Indian entity. Okay, so that is the definition. Regulation. A new act was enacted in the year 1999, Foreign Exchange Management Act, replacing an earlier act. Okay, so this is a consolidated policy on foreign direct investment and non-debt instruments, which are guided by the master directions on the FDI and the reporting angle out here. How an investment can come? There are two mechanisms: automatic route, certain sectors, certain the way of investment is under automatic route, where the AD bank, that is the bank where the investee company is holding an account, their banker can approve this transaction, and or if it's a approval mechanism, the requisite request needs to be submitted to the ministry or the Reserve Bank, which is a central bank in India. How, in what form it can be done, as our learned counsel, Ms. Neha Sharma, had spoken about it. Equity instruments, equity, that is equity shares, warrants, CCPS, and that is fully convertible shares, preference shares, and bonds as well as CCDs. Reporting, there is a requirement of reporting of all the investments that have come in the form of FDI. There is a regulatory portal which is a firm's portal. So that's earlier it was done through the AD Bank. Now they have put up a dedicated portal. This is done by the regulator in the country. Okay, that is for firms foreign investment reporting management system. So this is the platform where the investee company needs to report within certain timelines. So we move on to the life cycle here. Well, how does this FDI happen? So there are, if you look at it, there is a pre-transaction stage. So what is a pre-transaction stage? Where we are actually finalizing the sector, whether it is under automatic or approval route, and then we decide on the remitting the proceeds. So these are pre-transaction stage. There are certain checks and balances that needs to be done, which we'll be looking up in the subsequent slides. Then at the time of transaction, so this is the second step. There will be certain declarations to be provided to the bankers so that the money is credited into the account. Then there is the fourth step of issuance of shares and reporting to the regulator. Finally, the post-transaction stage, where there is a requirement of disinvestment or repatriation of dividends to the parent company. Okay, so we move to the next, which talks about the investment route. So under automatic route, we try to capture certain sectors out here. Not necessary, this is exhaustive. These are some of the regular ones. So if you look at automatic route, ITITS, computer hardware, manufacturing, single brand outlet, these are all under automatic route, which can be done by the AD bank within the country. Partially automatic, if you look at certain sectors, defense, which is automatic up to 74, but once it crosses 74% of the shareholding pattern, then it has to go to the government for approval. Banking, it is automatic up to 49, and above that, it will again go to the government route. Insurance sector, automatic up to 74%. So just trying to put in some industries out here, not necessary that we try to cover everything out here. Approval route, see anything above 51% in a multi-brand outlet, publishing a newspaper, about 25-26% stake requires to go to the uh, regulator for approval. So satellite establishments and other related activities, 100% is under approval route. What are prohibited sectors? If you look to the extreme right of the slide, certain sectors that are not allowed: lottery business, okay, business, atomic energy, nidhis, a type of NBFC, that is non-banking companies, floating funds and all, trading in TDRs, chit funds, gambling and betting. So these are some of the sectors where it is not allowed. One more important guidelines that we should be keeping on apart from the sectoral cap is basis the guideline issued by Government of India on April 2020. Certain that is land border sharing countries that is within around the Indian subcontinent. Those are countries like Pakistan, Afghanistan, China, including Hong Kong, Macau, Nepal, Bhutan, Bangladesh. They are restricted to do a investment in the country. Yeah. So we move to the next. So how does the flow happen? So trying to explain in brief, the investor would initiate a fund transfer to the investee company. The nostro is credited. There is certain requirement of a KYC, that is know your customer. The investor has to, the investors bank provides certain information which is initiated either proactively by the investor or by the investee in the country through their bankers asking to give certain information as per the regulatory requirement. I will give you those details. There is a declaration that needs to be given to the bank while settling the funds. The funds get credited to the investee company, and there is a remittance certificate and a KYC which is received from the foreign bank is provided to the investee company, so that subsequent reporting to the regulator happens. So we move on to the next. So I spoke about know your customer. This is an important guideline that has to be followed by any entity wishing to invest in India. So there are six requirements of the investor to be provided by the investors bank to the investee bank. Okay, so what is it? These are simple guidelines which talks about who is the remitter, any unique identification number of the investor or the entity. It could be a SIN or any other corporate number that is there for that entity. The bank name which is remitting it, the account number of the remitter, and the period of banking relationship. So this is a prerequisite for us releasing the funds into the investee company. So this is very vital. We should make a note of it that without this, the funds are not created. This is a regulatory requirement. Okay, so it can come in a form of the same 103 message while initiating a fund transfer, or it can come in any other MT199 message types. These are banks that send messages through the Swift platform. So in that, you can send this information. We move on to the next. So what are the reporting requirements? If you look at it, FCGPR, okay, this is foreign currency general provision reporting. FCGPR filing has to be done at the time of issuance of capital. There are certain guidelines, okay. Shares to be issued, that is after the investment is received, credited to the investee company. Shares should be issued within 60 days, and within after that to be filed in firms within 30 days of issuance. So there are two steps. First step is after receiving money, share allotment should happen within 60 days, or else it has to be returned back to the remitter if it is not allotted. Then once the shares are allotted, it has to be filed on the firm's portal for regulatory reporting. FCTRS in the event of share transfer. So there is a possibility that I have already invested and I wanted to do a transfer. So it is foreign currency transfer of shares. There again, the request to be submitted to the AD Bank within 60 days of receipt of funds and the transfer of shares on firm's portal. Okay, downstream investments, entity already where there is a foreign stake, that entity is investing without any receipt of funds. There is a requirement to report 30 days of from the day 30 days from the date of allotment of shares. LLP, limited liability partnership, again there is a 30-day window for reporting once the remittances come. There is a separate reporting format for LLP, and LLP2 is for transfer of shares for the LLP entity. So that's on the foreign direct investment. We talk about ODI, that's overseas direct investment. I invite my colleague Keshav to provide you the inputs on overseas direct investment. So these are for entities trying to invest out of India into Germany or any other country. Yeah, over to you, Keshav.
Yeah, good morning, everyone. So we have covered how a foreign entity can invest in India. So now we'll be covering how a person in India, either an individual or an entity, can invest somewhere abroad. So what is overseas direct investment? Basically, investing in any of the equity capital of a foreign entity is called as overseas direct investment. So this could be either shares or compulsory convertible instruments like compulsory convertible debentures and compulsory convertible preference shares, or it could be in the form of capital contribution in a limited liability partnership. So this could be through an existing entity or through subscription to memorandum or through transfer of shares from an existing investor. Now, there is only a single restriction that is there in an overseas direct investment. The entity abroad should be a limited liability entity. So either limited by capital contribution or limited by shares. Now, there is a portfolio investment also where investment is done in either a listed entity for less than 10% or in a fund. This is also considered as overseas investment, but this is considered as overseas portfolio investment. And the regulation guiding that is separate to what is overseas direct investment. So can we move on? So who can do an overseas direct investment? So any Indian entity that is limited by a limited liability, like in a limited liability partnership, a private limited entity, or a limited entity, and a partnership that is registered under the Partnership Act 1932, they can undertake overseas direct investment. Also, an individual can undertake overseas direct investment up to a limit of a liberalized remittance scheme. That is the regulatory requirement for investment for an individual outside India. So, like why we need to look into overseas direct is that either an entity that has an investment from Germany who would want to look into opportunities in near geographies to India, for example, Sri Lanka or Southeast Asia, they could look into this opportunity of overseas direct investment, or there could be investors in India who would want to invest in Germany, who could take this route to invest, further invest and invest into business opportunities in Germany. So can you move on to the next slide? So what are the two routes by which we can invest through overseas direct investment? So like we had in the foreign investment part, there are two routes, that is automatic route and approval route. So automatic route is the route by which the authorized dealer can give approval for undertaking the overseas direct investment. And the approval route is the route where you will have to go to the regulator, that is the Reserve Bank of India, to get an approval for undertaking the required investment. So how do you categorize this particular remittance as automatic or approval is if the investment is within 400% net worth of the Indian entity, then it would be categorized under automatic route or up to a maximum of $1 billion or equivalent euros or pounds. If it is exceeding this particular criteria, then you will have to approach the Reserve Bank of India for an approval. There are certain other categories where we would require certain approvals, like if there is an investment in a financial service sector entity abroad or strategic sector entity abroad, this would come with regulatory requirements that are either required under other guidelines, but we will not get into that right now. Now, there are certain prohibitions where you can undertake overseas direct investment. So real estate and gambling and dealing with financial derivatives are some restricted areas where overseas direct investment is not allowed by the regulator. Can we move on? Yeah. So how do you do an overseas direct investment? So first, the investor would identify whether the investment will fall under the automatic route or the approval route. If it is under the approval route, first you will have to approach the regulator, get the approval, and then approach the bank. If it is under automatic route, the investor can directly approach the bank. So what do you mean by approaching the bank is there is a form called Form Financial Commitment. This, along with the required list of documents, need to be submitted to the bank for undertaking the investment. So once the investment is done by the bank, they would issue a unique identification number. This unique identification number is for the foreign entity. So any investor in India investing into the same entity abroad would have to quote the same unique identification number and will have to route the remittance to the same bank. Now, once the remittance is done, the bank, once they issue the unique identification number, will report the transaction to the regulator. Then there are certain obligations that has to be done by the investor. So this will be covered subsequently. So once these obligations are completed, the foreign investment can be repatriated either through dividend or through transfer of shares. We can move on. So what are the obligations of an investment? So any dues that is liable to be repatriated should be repatriated within 90 days of the date on which it becomes due. So for example, if there is a dividend that is declared by the foreign entity, from the date of declaration, the repatriation should happen within 90 days. If there is an interest that is to be paid, from the date of the interest being due, it should be repatriated within 90 days. The second obligation is the submission of evidence of investment. So if it is a limited entity or a private limited entity, then the share certificate should be submitted to the AD bank within 6 months. If it is a limited liability partnership or a limited liability company, then they should give a confirmation that the percentage stake has been transferred to the Indian investor within 6 months of the transfer of remittance. And one more obligatory requirement is to file an annual performance report of the foreign entity with the AD bank. So this has to be done by by December 31st of the subsequent year of the investment, and this has to be done till the date of disinvestment. So let's say you have invested this year, and the foreign entity's financial year is January to December. Then your first annual performance report would be filed at the end of next year by December 31st, 2026, and then subsequently you will have to do an annual performance report filing until the disinvestment is done. So with that, we conclude the presentation on overseas direct investments. We can take queries on either foreign direct investment or overseas investment.
Yeah, so one thing I want to add here, there is another instrument, external commercial borrowing, as Ms. Neha had highlighted. We are not covering in the interest of time. This is raising capital by Indian entities overseas. So also the market is subdued. We find very few borrowers going abroad because of various factors. It would be hardening of interest rates, it could be geopolitical, or it could be the volatility in exchange rates. So we have not covered that, but we are open to take queries. If there is anything on ECB, we have provided the information here, both our India and German office. We are free to reply to you or assist in any of these transactions. Any questions on the FDI, ODI we are going to take?
Thank you. We are coming to the question answer round very soon. But thank you, Mr. Singh. Thank you, Keshav, for joining us and sharing those insightful statistics, parameters, and also the plethora of opportunities that Indian banking has to offer. And I really appreciate you addressing us on those valuable tips on how to keep businesses running strong. And additionally, we want to thank you both and ICICI Bank for partnering with us today. And we are truly grateful and hope to continue to benefit from your much valued presence going forward. And now, without any further delay, we move on to our Q&A session. I invite you, dear audience, to share your questions in the question panel. And I shall commence with the first one, which is directed to Neha. Neha, can we have your audio on? The first question is, can we make direct payments to the creditors or vendors on behalf of our Indian subsidiary until we fund the company?
No, Monaz, the simple answer is no. You cannot make any kind of payments on behalf of your Indian subsidiaries to any vendor or their creditors. It's simply prohibited under the law. So please don't do it. Just please wait for getting the funds in and then let the Indian company utilize the funds for make the further payments.
Okay. Thank you for very briefly and answering that question. The second one is also directed to you here. The requirements of Indian subsidiary is now changing. So can I change the terms and conditions of the ECB that I have lended it?
Yes, again, the simple answer is yes. ECB is quite flexible in that sense. If you think that the requirements have changed or you want to increase the average maturity period, or if you want to change your repayment plan or withdrawal plan, you can do it. But of course, it has to be within the contours of the law. For example, if law says that the minimum average maturity period has to be 5 years, then in that case, if you can change it, but within the 5 years, it has to be 5 or 6 or 7, but that's your wish. So this is how, yeah, the flexibility is there, but within contours.
So timeline plays a vital role for.
Exactly. You cannot any time go beyond the law. So whatever the law is saying, you can keep changing, shuffling your terms and condition as per your requirement, but please abide by the maximum limits that are provided under the law.
Yes, thank you. And I believe we have room for one more question here. Can my Indian subsidiary make a prepayment of the ECB?
Again, yes and no, because it depends upon the minimum average maturity period. If you have reached to that level, that minimum average maturity period has achieved, then of course you can still make the prepayment of your loan. But if it is not has been achieved, that you cannot do so unless you have a special permission from the from RBI. It provides this permission in special cases, but in generally it's not allowed.
All right. Thank you. Thank you so much, Neha, for addressing those questions very straightforward and directly to us. Ladies and gentlemen, if you have any further questions, don't hesitate to reach out to me or our speakers directly. We would be happy to continue the conversation one-on-one and provide any additional information that you need. And with that, a big thank you and a shout out to our speakers for joining us on this webinar today. And dear attendees, thank you for your patience listening, your support. It's very encouraging to see you turn out in large numbers, and I look forward to connecting with you very soon. And finally, our brilliant backend team from the embassy and Effie, Jessica, Larissa from my side, a big thank you for your continuous support, and the ICICI Bank. Till next time, and auf Wiedersehen.
Thank you so much, Monaz. Thank you so much, Mr. Singh. Thank you. Bye-bye.